Good morning, good morning. Welcome to Market Pulse this Wednesday morning. Of course, today we'll be looking at the global market outlook, particularly in as far as investment go. And to help me with that conversation, I'm joined in studio by Paul Njoki, the head of Affluent Banking at Standard Chartered Bank. Paul, karibu to the program.
Thank you, Jimmy. Thank you.
All right, so the first thing that I really want to get your sentiments on is what are you seeing? Where are the investors' sentiments? What kind of investments are they looking at the moment?
Okay, so thank you very much. So as we roll out our half to global market outlook, one of the things that we are seeing is that there's a likelihood that interest rates will start coming down following decreased or lower inflation numbers. And that, Europe is leading the way, but of course we believe that the US market will also join very quickly. And that will trigger a global revision of interest rates lower. And that also may happen to our local market as well. So that has quite a number of implications in terms of the investment categories that our investors should be looking at. Firstly, we are looking at the equity markets. And in that space, we think that with the lower interest rates, the rally that we are seeing in the US market will actually be supported and continue. So there's potential in the US equity markets. Then, of course, we are looking at India, particularly because they've done well. They have a fantastic local demand that again gets supported, and we see that being positive. Yeah. But overall, even at a global level, global equity we are also positive on that. When you turn our vision onto the bond markets, we believe that the bonds are now yielding at an all-time high now in terms of this rate cycle. Yeah. And as interest rates started coming down, the bond yields will also follow. So it is imperative for investors now to start thinking of locking in the gains that you have, so that you are at a higher yield than the prevailing market yield. Yeah. And of course, if investors are looking for a little bit of value in the bond markets, we are seeing that in the emerging market, US dollar denominated bonds, because in that case, then the differential between the US treasuries and the emerging market US dollar bonds is still has a value. So for customers or clients with a slightly higher risk appetite, again, that's a category that they can go to.
All right, because I would really want to know, again, in Kenya particularly, we have been in a period of monetary tightening for quite some time. We're yet to see those rates come down. So how has that impacted the kind of investment and the decisions that investors are making?
Okay, so in the last 1 or so years, I think government bonds have been very lucrative. Local currency government bonds have been very lucrative. High of 16, 17, even some of them almost at the 18%. Yeah. That is quite lucrative for an investor who has cash at this moment, right? And what we are seeing now going forward is clients who are already holding Kenya government bonds, local currency government bonds, should continue holding, because it's likely that as the US and the rest of the markets leads in rate cuts, so will Kenya follow down the road, right? Yeah. So that elevated level of yield, 15, 16%, is a good yield to stay, okay? For investors who have not come in, there's still value for them to get in, because if you're getting at a level of 15, 16% level, and you're locking it for 5 or 6 or 7 or 8 years, yeah, even if interest has come down even to 10%, you can see you are left with some really nice value there. And of course, from an economic perspective, and this is the fundamental equation for investing, yeah, is that when interest starts coming lower, bond prices will rise. So if you're buying your bonds at a discount right now and interest start coming up, they will actually go to a premium. So you can sell them off in the next 3 or so years, and you recoup that mark to market. So there is opportunity in that space.
Yeah, so let's talk about the volatility that we have seen within the currency space and the FX market, for instance. Just this past week, we've seen the shilling drop to as low as 132. This is against a rally that we had seen at the beginning of the year. So for investors who are based in Kenya, who would want to invest, let's say, in the US, what challenge does that then present?
Okay, so I think firstly is that so there's 2 ways of looking at currency. One is the very short term, which means I want to get in and out. So there it becomes very difficult to pinpoint. Would it be 132, 130, or 134? That's always a difficult space. But if you're looking at a horizon of 3, 4, or even 10 years, now it starts becoming clearer, because you can look at the trend that the currency takes over over a period of time. And this is not just a Kenya shilling. It's most emerging market currencies when they are put against, you know, the US dollar or the euro or the pound, right? The trend is that they will depreciate over time. And that is fundamental because, you know, you import your oil, you import your medicine, you import a couple of other things. Your imports are higher than your export. So you will always have a difference, a deficit from a balance of trade. You'll need more dollars to procure you know, imports than you will make dollars from the exports you've made. So that will always keep a pressure on the local currency. You know? So for an investor, the way we look at it is, what are you investing for? What is your life goal? If you're investing for retirement and it's coming up in 10 years, go ahead and get your dollars and invest today. Okay? But if you're very short term and you're saying, I want just to think of the next 3 months or 4 months, I would say maybe stay in the shilling and your return on the T-bills or the bonds or even bank deposit, and you'll be still pretty, right, for 3 or 6 months, you see? So that's the way we look at it.
All right, so let's zoom into the Kenyan investor particularly, and during the current macro environment that we are seeing. When you look at the different asset classes, where are you seeing a lot of traffic going into?
Right now, a lot of traffic is going to the money market funds. We have our SC Shilingi fund that is also growing quite significantly. And I think the data that's being published as well, you look at the other fund houses that offer money market funds are also growing quite steeply against the equity funds. The equity funds have not done well for a period of time. The balance funds are somewhere in the middle, right? But the money market funds are doing very well. Of course, the underlying assets or securities in the money market funds are bonds and bank deposits. So then you can actually translate and see if the bonds are giving a good rate, T-bills are giving a good rate, you go to your bank deposit, you get a good rate. Then it goes without saying that that gain is being, in a money market, is transferring as well to the investor. So that's an asset category that's growing very, very steeply at this.
All right, so just looking at the different asset classes, and I'm sure these are conversations that you're having with a lot of your investors, apart from, let's say, the money market funds and equity investment, what are the actual, I mean, like we have seen a lot of Kenyans saying, I want to buy land. Do we still have those group of investors who actually want to buy assets, things like land, buildings?
I mean, traditionally Kenyans have loved land and in different shapes and forms, but let me say generalized as real estate. I think the growth of real estate, both from a return perspective in terms of variation and yield in terms of how much you can get out of it. If it's an apartment block, how much you can rent it out and get the yield. Over time, that has deteriorated. I think on the higher end of real estate, I think you are getting a real estate yield, annual yield of about 3 to 5%. Okay, if you go to the middle tier, maybe you get up to 9, at best 10%, right? From a valuation perspective, property values are not rising. They are stagnant, and they've been stagnant now for a couple of years. And if you look at the horizon, I think they will still stay stagnant because the supply is there. I mean, you can see, you walk around, you see a lot of to sell, you know, apartments to sell, houses to sell, right? If you open the newspaper, you see a huge column of property on sale. So that will keep the pressure on rising, on property prices rising, because there is a supply and demand, right? On the other equation, which is the demand side, which is me and you want to buy a real estate property, either we have the cash or we go to the bank to get a loan, right? The bank loans right now are quite expensive, right? And if you have the cash, then you are asking yourself, should I put it in the apartment, or should I get government bonds, or should I invest in these other markets, right? So those are the forces that are controlling the real estate space, and I think it will remain controlled, at least for the foreseeable future. So my view is, while traditionally real estate has provided a fantastic opportunity for Kenyans to invest, I think time has come that we need to look at that asset category in the light of what other alternatives are there, and pound for pound, check whether actually we are making a return, a better return than the other. And if the answer is no, then voila, you are an investor. You should not have any emotional attachment to any of the asset category, right? You just decide, okay, this one is making more money, the risk is lower, and that's what you buy.
All right, so Paul, looking at the second half of the year, where do you see the risk? And just look in terms of the risk. I mean, we've seen a bit of disruptions over the last month or so. So what are the other risks that investors are likely to face in the second half of the year?
Okay, I think there are a couple of uncertainties out there. Globally, of course, the US is going through elections, and I think this year we know that most economies will go through election. The UK just completed theirs. India has completed. US now is going later in the year. So there's uncertainty there, but we'll see what happens there. We have two wars, the Eastern Europe war and the Middle East conflict. Again, how that pans out and the dimension that the global politicians take in terms of addressing that, and of course in the emerging markets with the change of or rather the demographics, young people, a big batch of young people coming up into the space, and what that brings again is something for leaders to solve for. But in the short term, I think we are still positive. We are positive because of the leading the things that as an investor you need to look through beyond the volatilities of the day, right, or the happenings of the day, and those is the direction of interest rates. Okay, that for me is the fundamental thing that drives how investment categories work. And the view now is that interests are coming lower, and that is giving opportunities to invest in different asset categories that are supported by lower interest rates.
All right, so I'm thinking for a Kenyan investor, now that you've mentioned the fact that interests are expected to start coming down, of course we expect the Fed to lead and maybe BOE at some point, but the question is, what specific asset classes should I as a Kenyan investor be looking at in the next 3 months, in the next half of the year?
Yeah, I think the bond market will pay off. As I mentioned, the rates are all-time high, at least in this season, 15, 16, 17%. Anything that you can lock in at this time for the next 3, 4, 5 years, vis-a-vis interest rate starting to come off, that differential will pay off as an investor. So I think that's a fantastic opportunity. Of course, you can go through the straight into the bond market, or you can follow the money market route to still get into the bond market.
All right, so again, just let me go through some of the summary of the views that we have seen earlier on today. I mean, like your expectations that equities are currently overweight. When you look at something like gold, it's neutral. When you look at something like cash, it's a bit underweight. So for other investors, apart from these asset classes, what would you advise me, for instance, like where else do I put my money? Do I put it in gold? Do I put it in, you said of course bonds are going to be, to do better, but again, when you look at equities and specifically equities in Kenya, they have sort of struggled. We haven't seen a major shift in that space.
Yeah, so as an investor, the first thing I'll start is by understanding you. What is your life goals? I think that's always important because, I'm on record saying that you cannot take the medicine that the earlier patient took. You can't tell the doctor, give me the medicine you give to the previous patient, right? You'll have to do your own, diagnostic, right? So that's where we'll start. But if we generalize and say you're a moderate investor and, and then we start from there, then I would say, firstly, allocate a part of your investment into global equities, a portion of that, right? And if you want to go sub-segment of global equity, I'll say US, okay? Okay, so that's number one. The second thing I will say, have a proportion of your investment that is in the bond market. Now, that you can slice to local bonds, or you can say, US dollar bonds as well. And if you still want to go a slightly, a dimension, you can say emerging market, US dollar bonds. So again, so that you get the value. In terms of cash and gold, if you're holding, that's why we are neutral. If you're already holding, so the cash is other way. So, but gold is neutral, right? So if you're already holding gold, stay. Don't add, don't reduce. Okay, that's why it's neutral. But if you have cash, you need to start releasing your cash and invest, deploy your cash. Because if you stay with cash, that's why we are underweight. We want you to reduce your cash holding because bank deposits, be it term deposits, the horizon in terms of you earning a good yield is coming to an end as interest rates start coming down. So allocate that cash either into equities or allocate them into the bonds so that you have sustained return going into the future. So that's how I would advise. And really, this is for a client in Kenya. This is a client in any other part of Africa, and is the same advice I would give to a client in Asia or even in the US, right? Because at the end of the day, as an investor, you need to look at yourself as, this is what I want to achieve in my life. Okay, I want to put my child to education. I want to retire here. I want to put an emergency kitty. What are the possible available ingredients for me to build that portfolio? And those ingredients are, some of them are local, some of them are global. Okay, and as Standard Chartered Bank, we offer you that capability to not only invest locally, but also to look at the overall landscape and invest globally, and we are able to deliver that digitally as well.
All right, Paul, I think that's a good place to end it. Thank you so much for making time to be on Market Pulse this Wednesday. Let's do this again, same time, same place, right here on Hot 96.